Obviously, you've got the Faang stocks, the Facebooks, the Amazons, Apples, Netflix, Googles right there in the NASDAQ. They've accounted for 99% of the S&P 500 gains for the first 6 months of 2018. Forget the NASDAQ. But my next guest says that's a red flag for the broader market. He's got a way for you to avoid getting bitten. David Spika is president of Guidestone Capital Management on the set right now. Okay, how do I do that?
Well, I think what you do is you look at a change of leadership. What are we seeing today? We're seeing financials outperform. Healthcare might be an option, too, but the market has gotten way too narrow, and you see that when stocks get that overpriced and the market gets that narrow, you have a slip-up in Netflix or Facebook, and all of a sudden money starts cascading out of that sector. If the market's going to keep going up, you need another sector to take over leadership. Financials are a great place to go.
Somebody just said the other day, but technology is so deeply woven into the DNA of who we are now that it is a bet on all given days.
Did that person forget 1999 and 2000?
Okay.
Yeah, so technology, clearly, there's opportunity there, but at some point valuations get too far ahead of themselves. I mean, these things aren't going to continue to grow exponentially forever, with the exception of maybe Amazon, but overall, you've got to look at what are the expectations for the stock? What are the expectations for the economy, for the broad market? And when that gets too extended, it's time to start looking elsewhere.
Are you saying the 4.1% GDP is too extended?
I'm saying that 7% nominal GDP feels a little bit hot. And so what that means is the Fed now really has a green light, right? They've got 7% nominal GDP in the second quarter. They've got full employment. They've got core PCE at 2%. Jerome Powell's going to keep raising rates.
Okay. The president has said, boy, I think that would be not a great thing. And he said it in different terms than I did. But he's got to raise rates. You can't let an economy get hotter and hotter and not sort of temper it with higher rates.
Right. And we also,
so is that the theory behind your financials names? And what are they that you really like? Which areas of financials?
That's part of it. We do like the big banks, so J.P. Morgan or Bank of America. I mean, some of the asset management plays look attractive, too. But not only the yield curve story or the rising rate story, it's really about if you're going to invest in this economy, you just can't be focused on tech. There has to be other areas of the economy. So if the Fed is taking liquidity out of the economy, that liquidity has got to come back in from someplace, the banks. That's the normal function. Bank lending starts to increase. Businesses need capital. That's where they get their capital. They continue to grow. What's
your plan B if the banks suddenly don't react the way you expect them to?
Well, a nice barbell approach would be owning healthcare, too.
Okay.
Because we are a very late cycle. We're extended. This is a 9 to 10 year bull market. It's almost the longest expansion since World War II.
Does that worry you? This thing just keeps going, and it's so beautiful. But if I listened to people a year ago who sat in this chair and said, Liz, it's gone on too long, it's 8 years old, you would have missed out on a beautiful run over the past year or two.
But think about what the latest catalyst was. It was fiscal stimulus. It was the tax cuts, right? That is something that's not going to continue to propel things higher. At some point, we're going to have to see things start to roll over.
Why is the Russell rolling over more painfully than the other indexes today?
Oh, I think because it's considered to be more high risk. I mean, you're seeing kind of a lower beta sort of move, a lower risk sort of move when investors start to, again, you see these high flyers like Facebook and Netflix start to stumble. What are investors thinking? Uh-oh, time to get defensive, and that's what they're doing.
Anything worry you, keep you up at night when it comes to these markets?
The main thing that worries us is tightening financial conditions, primarily the Fed. Okay. We're coming out of...
Well, that worries the president, too.
Well, for different reasons. We're worried about it because we're coming out of the longest period in history of monetary stimulus to the degree we've never seen before. That forced stocks up. As it comes out, stocks are going to have to follow that down to a degree, and we don't really have a playbook for this. We've never seen it before. That's what concerns us. And you know what today? Cash is becoming a relatively attractive asset class again.
Well, how about Bitcoin? Are you a Bitcoin boy?
No Bitcoin, no Bitcoin. We prefer traditional asset classes. But think about it. If cash is going to yield 2.5%, 3% like the Fed wants to push it to, and stocks are getting really expensive, investors are going to think twice about having too much exposure in that part of the risk spectrum.
I wanted to leave this till the last moment. You have $14 billion in assets under management. I've been following you for a long time. What's the number one thing that you've done right over all these years?
The number one thing is have a long-term focus and manage risk appropriately. You've got to be managing risk. You can't just ride things to the sky. And that's exactly what we've done, and our investors appreciate that.
David Spika, good to have you. Come back soon. We appreciate it.